What's up, everyone? Welcome to another monthly webinar of Mogul Club. You've got myself, Alex Bias, CEO and co-founder here with that's a that's a transition to you, Joey.
Oh, and you got Joey over here, co-founder and COO. Sorry, I missed that cue.
Wow, we are simpatico today. It has been one hell of a week. I told Joey we should probably just riff for a minute or two as we have people joining. I mean, those numbers continue to climb up, but yeah, I mean, Joey, what's going on with the firm?
Yeah, Fern makes its way in and out of the camera, as you noticed in past sessions. Stacy, my lovely fiance, has brought it back into our lives, and so enjoying its presence behind me here.
It's not fake, you're sure?
Oh yeah,
Oh,
100% real.
okay, all right. Dude,
100% real.
I noticed a difference in the camera. This is the new laptop, right?
It is. It is. You sniped that. You
Yeah.
sniped that.
I was like, it's way more vibrant, the colors behind you.
Yeah, you can actually see me now. You can see all the perfections, all the imperfections.
Perfect. All right, let's jump into it. That's enough of the riff. I think we're at a critical mass here, but obviously we got a jam-packed agenda between dividend updates coming out last week or 2 weeks ago now, and then on top of that, going through the new properties, and then a surprise for later on. Hint, hint. But basically, let's kick it off with dividend update. I mean, Joey, we got 11 of 16 above double digits. We got 12 of 16 at double digits or better. Walk me through it. What happened? Why was it such a stellar month? What can we expect in the months coming? Because, I mean, that's just that type of consistency and quality I said in a LinkedIn post is just unheard of. So just walk us through.
Yeah, 100%. I might as well even just share the LinkedIn post here. Obviously, the month was stellar. The month was just stellar. You know, a lot of our top performing properties were a good mix here of both midterm and short term rentals. Obviously, the Andres completely outperformed itself, and that was with debt service. Very, very impressive there. We did have some additional income related to pet fee income, in addition to a kind of unique mark to market opportunity, replacing one of the bedrooms for a shorter term tenant that's only going to be there for a few months initially. So just great opportunity. Just goes to show, some of the potential, especially of both the pad splits and the STRs. And you see the Roman right there. Stabilized property, been operating for well over a year, still performing north of 1%, especially during the warmer months there. You have the victim of the fee following close behind. Celeste, another stellar STR out in Texas, and you have the Krakow, another stellar STR in Texas. The Shiv, always a strong performer, in and around 1% consistently. The Wags as well. Rhodes is another pad split out in Arizona, and on and on. You have the Chelsea, the Guides Hawk, two additional stellar pad splits that are always consistently performing around that kind of 80 to 1 point, 80 bips to 1 point a month, which is again annualized, 10 to 12%, which you're just not going to find on any other platform. Axelrod, always a strong performer, and that's one of our larger properties that we did in Texas, not dissimilar to the Johnson 1 and Johnson 2. And then you have the Prince coming in strong. A little bit of a lower month relative, but 70 bips for the Prince is still really, really strong. We just had turnover with one bedroom. Totally normal, happens all the time. Kendall, similar story. We got that one fully ramped up after new ordinance from the city a couple months ago. That one's going to continue performing in and around that kind of 70 bip to 1 point range, which we really, really like there. And then the Johnson and the Logan following close behind. Just overall incredible performance. When your lowest performance in a month is 6% for a year net cash, you're doing something right.
Yeah, not to mention that 6% is net taxes too. I mean, 6% in another platform would be 3%. Antonio, great message. I'm a bit late to miss much. Note, we were riffing for 2 minutes, but we dove into a recap of the June dividends. So appreciate you joining. Feel free to leave a comment, question in the chat or in the questions if you want to stay anonymous. We're just going through the June dividends. You mentioned pet fee income. Walk us through some of the ancillary income streams that you can get from Airbnb. Why is it that we got some pet fee income in one of these properties?
Yeah, and it actually happens across all properties too. It's a great question. Lots of ancillary income opportunities, mostly present in the form of pet fees, late checkout fees, in addition to actually additional cleaning fees that sometimes net positive to what we have to end up paying the cleaning teams. Now platforms like Airbnb will automatically collect the cleaning fees for you. You can set them at a certain rate, and then you work with your own vendors and kind of figure out a little bit of pricing arbitrage there. It's actually net positive some months. So our partner Umberto has always been tremendous about that, frequently realizing positive additional ancillary income on the cleaning side. And then obviously you have your pet fees. Everyone loves their pets, midterm and short-term rentals. People are always trying to travel with their pets. It's actually wild. And I definitely support, as a proud owner of 2 Shiba Inus. But yeah, great opportunities for ancillary income. And that's always just gravy on top, right? I mean, you have the core kind of top line, gross potential rent of these properties, netting you that 70 bip to 1 point, at least consistently on historical performance. And then anything on top of that is just can be gravy, when it comes to ancillary income. It's a great question.
Yeah, you were the first person I knew ever, and I'm gonna blow up your spot a little bit. Feel free to do it to me too. It's fine. It's fine. I can take it. But you were the first person I know to celebrate Father's Day for being a dog dad.
Oh yeah, absolutely.
And so I don't know, like that might turn off some people. It definitely turned me off. It left me with a little sour taste in my mouth. I was like, do I pick? I don't know. Do we go through
I
with this?
think I think the chat would definitely support me, but I mean, you guys let me know.
Yeah, I mean, whatever. We'll get through it. Even if they are dog dads and celebrate it on Father's and Mother's Day, God forbid, whatever. I won't yuck your yums, but I was like, holy crap, that's a new one for me. No, I mean,
Oh,
tremendous month. Obviously, Airbnb has that seasonality component to it, and so with roughly 50 to 60% of the portfolio in that Airbnb, obviously you have it split up between that and pad split. Pad split being more of your answer to the workforce housing with that kind of 12-week plus lease timeline with an 8-bed, 3-bath, each individual room rented on an individual basis. So a little higher yielding. It's going to be definitely a lot more stable. Hence why you see in the top row, a majority of those are the pad split, and honestly in the second row too. And now, obviously in the summer months, we're going to see some Airbnb seasonality. So definitely a time to be checking into the Johnson too, as we just closed out on that property here and will be paying out its first dividends here shortly. And on top of that, too, we have a few other Airbnbs. I believe the Hugo is there too, so that one's available as well. So that's a recap on the dividends. We know we're doing something right when you see that much above 1%, not to mention that much above 10% annualized. And again, we pass along the tax benefits, so hopefully that 10% plus yield can actually stay 10% and might be a passive loss for income reporting purposes. Obviously, we joke the tax code was written by the IRS to incentivize 2 things: procreation and home ownership. While we can't help you with that first, we sure as hell can help you with that second. So that's what we're doing here in the dividends sector. I mean, I don't know if you had any wrap up, last minute points. Are you seeing more midterm rental or long term rental for your pad splits? Great
yeah.
question, Joe.
Yeah, perfect question. I was actually just going to segue into a reminder of the value propositions of both. So, again, as Alex kind of touched on, your midterm rentals, like the rentals that we run on Pad Split, are very, very high income yield potential, right? I mean, you're building effectively the closest thing to fixed income in real estate you could get, with very, very highly stable tenants relative to other business models when it comes to renting real estate. So, very high occupancy, very high NOI yields on kind of bases today when it comes to purchasing new properties, and you're all in costs associated with that. On the alternative, you're not necessarily going to see as much capital appreciation with these pad splits as you would in, say, STRs, right? Where you're building a true kind of operating business on the STR side, right? Fully equipped as you would a hotel, right? In a way, effectively, you're making a fully operating business. You're purchasing all the capital. You're buying in more of your core high entertainment areas, whereas your pad splits are kind of more in the peripherals, in the transportation arteries, really strategically located to be able to access important veins and arteries that are associated with, employment and more of your kind of transient employment, right? When it comes to, the month-to-month leases, 3-month leases plus in new cities, right? That's associated with that tenant profile. Again, STRs, you're basically operating a hotel. It's all kind of, what's the right word? Dispensable income that's being spent on these properties, right? They're travel destinations, they're hotels. People are staying in them when they're coming to cities for 1 night to 5 nights plus, and you're not going to see people in there for a month plus. So the occupancy is typically dip here and there, and there's seasonality involved, but you're getting a much higher average daily rate per night. And then again, you're also building that business, right? You're an operating business, so you're getting capital appreciation. You're buying in core markets that are growing. So that's the different value proposition between the two. And then going forward, I think it's still going to be a relatively good split of around 50-50, maybe even tipping a little bit more towards the pad split model as we launch additional portfolio here.
Of course, yeah. I mean, we're big fans of the pad split team. Obviously, good friends with the team over there. So close relationship, and definitely seeing continuing to obviously grow out. And then Ramesh, or sorry, it was in the question chat. What kind of demographics do you use pad splits? I will say it definitely is city by city. So like if you're in a city like Boston, for instance, you're going to go a lot more towards your grad students, your master's students that really just want a place to stay. But if you're closer to a hospital, you're going to get your traveling nurses. I mean, Joey, are there any other demographics that I'm missing there?
No, that's 100% spot on. It's like sublet, like 3 month to 5 months, even plus. Right, people going to different city versus pilots, etc. Amazon warehouse, executives, all these people that travel to different locations and are typically visiting cities that they're wanting to live in for 3 months, and then the average attendance of being 9 to 12 months, which it is. So it's really unique. It's definitely discovered something.
Joe, we're seeing a little bit of a delay on your end. Is it still we good? Your internet working?
Oh yeah. Could you guys
Sorry.
hear me? Okay.
Yeah, it's a little bit of a delay, but whatever. We'll power through. Worst case scenario, I've got to take the reins. But anyway, it's cutting in and out a little. Cutting in now a little bit. It'll be fine. We'll get through it. Anyway, if you have any questions, feel free to leave them in the chat. Obviously, as we continue to go through it, we'll jump into it and go through all things Mogul. Slight delay, but yes, yeah, that was a comment in the chat. Joey, maybe the new computer is not as new as we might. Not just kidding. Anyway, let's jump into it. What should we do next? I think we should take a look at. Are there any other things that you need to add on? Oh, and there we go. All right. So Joey, just to give you, for instance, is in closer to the DC downtown DC area. So definitely something to consider there, especially as there we go. Joe, you back?
Yep. Sorry about that. Don't know what happened there.
No, it's all good. I was saying that you live closer to the White House than I do, so I don't know. Your internet might be a little bit funky there. I mean, what was it the other day when we just couldn't even get in touch with you for like 30 minutes? That was
Yeah. We got some highfalutin folks living in the building on the public side. It's been weird stuff going on with internet connections, but we're back.
Yeah. Meanwhile, you have me over at the bridge and tunnel crowd, so to speak, over in Arlington. I heard that term the other day for the first time in a while. I was like, "Holy shit, that term is a crazy term!" Like,
That's
just
funny.
anyway, let's dive into it. I think we go Breaking Bad, and we go into the namesake, the Pinkman, aka Jesse Pinkman, anti-hero there. It's a slacker in the show, but ends up being obviously a game changer. Do you want to dive into the Pinkman? Oh, that is
Little
all right.
preview right
Well,
there.
there's something later that might come out, but anyway, we got the Pinkman. If you want to dive into the Pinkman, let's walk through it. I know obviously we had a little bit of a surprise glitch there, but if you want to dive into the Pinkman.
100%. You can see the Pinkman right now, correct?
Nope, we can see a LinkedIn post. There we go.
All right, perfect. Yeah, so let's just go through the Pinkman here. Again, right here we have a very uniquely placed pad split here, kind of more in your downtown Atlanta metro central area, kind of closer to the CBD. This one is definitely really unique compared to some other properties that we've launched on the pad split platform. Right now, we are currently under CapEx renovation with the seller, as the purchase and sale agreement stipulated that the seller must complete $35,000 of repairs in addition to $10,000 of closing costs contributed towards the buyer's closing costs, which is our investors, obviously you guys, and all of us. And that has to be completed prior to closing. So we're getting effectively a brand new house. I will share that this house appraised for $485,000 about 7 months ago, and we got this one secured at a $500,000 purchase price. So do the math, 485K as is value pre-renovation, putting in $35,000 of seller paid renovation costs, and then in addition to that, you're getting 10K of seller paid closing costs. Tremendous opportunity for both capital appreciation and, as you can see, the yield is really, really, really strong. Average yield through the hold is 14.9%. And you're going to be seeing a cash on cash yield year one of around 11%. So super, super strong here. Really, really unique property. And even the as is pictures, look really, really good. Definitely excited to see how it turns out. We're monitoring the CapEx construction with the seller every day. And we've also opened up a pipeline with them, which is great as they're looking to partner with us on additional opportunities. So per usual, you can see how the property is capitalized, both in the property page and in the analysis tool. You can see how we're thinking about the year one rents and justifying them, in addition to the comps that justify the basis here. Normally you can go in per usual, play with your base case, bull case, and bear case scenarios, which will show you kind of what will happen to your dollar invested and based off of the amount that you're looking to invest. You can also do that on the analysis tool, which we can go through in a little bit. Super, super cool tool that Eitan and Alex built. So shout out to the team there. See the rest of the capitalization here. Again, we talk about the hold period. Typically we target, per usual, holding the properties anywhere from 5 to 7 years, could be north of that if they continue to yield, 12% plus per year. And ultimately the governance decision is up to you, right? As the equity holder, you get to make the governance decisions around sales and around, CapEx and make capital decisions with refinancing. So really, really strong market. I know Alex just released a pretty great deep dive into where Atlanta's going right now, but couldn't speak more highly about the robust fundamentals and the population and employment growth that's happening in Atlanta right now. It's just really, really great. So can leave some time for questions here. And again, you'll see the average yield and annual return switch according to the base case, bull case, and bear case. So we'll put it back to the bear case there, and you will see that baseline return.
Sweet. And if you're fresh, I think we just got another investment in it. If you refresh the page.
Perfect.
There we go. Nice. Good stuff. So this one, obviously, out of Atlanta. Atlanta's grown. It's booming like crazy. You've obviously heard about over the last little bit. I will say that not even mentioned in the email is the fact that Microsoft is devoting about $1 billion to a facility outside there, and it's going to be kind of HQ2 for Microsoft there. And so that's kind of high level there. I know we got a few questions. Feel free to leave them all in the chat, and we will get to them continuously throughout our time. But I'm new to the concept of pad split. I understand it's the individual bedroom rental concept. Is there a platform you're using like Airbnb for short-term rental? So pad split is the platform that we use. They actually pre-vet all of the tenants, make sure that there's a income to rent ratio that is commensurate with the risk, obviously. And so they pre-vet all the tenants. They've got incredible, robust risk infrastructure there to mitigate any sort of that. And so the idea is they actually offer it out directly through their platform, and controlling that kind of pipeline, they can obviously control a lot more of the quality of tenant that comes into it. Is it finding effective management for pad split challenging? Many PM groups I've worked with won't touch them. Joey, I mean, you're best suited for that.
100%. It's one of our competitive advantages. The management that we have for these pad splits is tremendous. We've got some cool stuff in the works where we're going to be revealing a little bit more about the management team in the coming months. But shout out to Aaron Shoemaker on the pad split management side. He's been a tremendous partner for us, and we're going to continue to grow very, very fast together as we scale up the pad split listings on our platform nationwide. But yeah, it's really all about the management. I always say that, like, none of the operation happens without management. Management knows everything. So they are the boots on the ground. They know what's going on in the markets. They know comps, but not only that, in comparative market analyses, they also know what's going on with policy and legislation, and they can actively see what's going on in active local court cases, any ordinance that the city's releasing or the counties are releasing in certain areas, even in and around Atlanta, where there's been problems, right, with the pad split model, the midterm rental model, the 31-day plus, 31-day minus models. These operators know what's going on and where that growth is happening. They can connect you with the right inspector. They can connect you with the right appraisal panels. They just know the infrastructure. And ultimately, I've learned more about real estate from these operators than I did while I was at Goldman Sachs. So I just couldn't speak more highly about the operational teams. And they are the competitive edge when it comes to specifically operations within the real estate.
You just name drop. Nice. Goldman Sachs. Anyway, and I do think, yeah, obviously acquisitions only get you so far. If a business plan isn't executed right, then you can't get even by that. So Sif said, I'm still researching your protocol and have two main questions. From what I understand, properties have are held for 5 to 7 years. Is there a process to give an updated valuation appreciation over time yearly? So we mark to market them on a monthly basis to give you better access and insight. Obviously, with real estate, it's a much slower moving market. So if you don't see a movement in a month, it's because obviously, as you can see, it's definitely a slow moving market, and we're only going to mark to market it when there is conviction around both either an increase or a decrease in price. And so that's there. Is there a possibility to offer investments without loans? As a Muslim, I can't use any interest. I understand the ROI may not make much sense if the property is paid in full. Thank you. To be honest with you, loans and the concept of accretive leverage is such an incredible power, especially as it relates to real estate. Real estate is a very unique asset class in the sense that you can originate debt that's long-term in nature. And as a result, you get a much lower interest rate relative to the risk that the lender has in lending to you as an individual, because you obviously have a much longer horizon to pay it out. And so as a result of it, if you have a yield above the interest rate, it becomes what's called accretive leverage, meaning your return without leverage is much lower than your return with leverage. So leverage obviously boosts that return. So unfortunately, we probably will only do levered purchases unless interest rates skyrocket to 25% or whatever it might be, that and our NOI yields cannot match that. But that being said, we originate the interest rate floor, and so right now we're getting quotes in that 6.5 to 6.75% interest only 10-year fixed loan. So unfortunately, if it does help, I mean, listen, I'm not trying to I don't know how to approach it. Anyway, if it does help, technically speaking, the LLC is paying interest. I understand that it's a religious thing, so I don't really want to touch on it fully, but it is the LLC. It doesn't actually have to do with you as an individual on the debt. Having the seller complete repairs prior to closing, doing a second appraisal, et cetera, is genius. Love it. Appreciate it, Nate. That's what we hope to do here, is continue that. And then Andy had a great nit. So we'll have, if Thomas, if you can run through that and just make sure that one is taken care of. How much are you looking to raise for the Pinkman? Maybe there's a goal number list that I missed. Joe, you want to just go through the cap stack real quick?
Yep. Give me 1 second. So here you can see how the property's capitalized, right? So you have your purchase price, you have your initial debt that's taken out at 70% LTV. And then you have the day one equity, which is the difference between the two. And then on top of that, you're going to have to capitalize your reserves and closing costs. So closing costs typically just cover any points associated with the loan, any and all of those 100 settlement statement items that you see at the closing table. And then we capitalize two forms of reserves as a reminder. So that's going to be a vacancy reserve and a maintenance reserve. Those two reserves are there to protect us. And so we never have to make capital calls as investors in these properties. Vacancy reserve covers typically 9 to 12 months of baseline expense load, including debt service. And then maintenance reserve is there to capitalize any repairs on the property that aren't covered by insurance and aren't typically elective. And then you have the Mogul platform fee, which is how we make our fee on the platform. Your return is already inclusive of that fee. The platform itself is completely free to use. We capitalize our fees within the cap stack of each property so as to minimally dilute each investor's dollar and dollar cost average instead of charging you to use the platform itself. And that's how you get to your total offering amount, right? You have your debt minus total usage, which is purchase price plus all these closing costs minus your debt, and then that accounts for the equity needed to close the entire property. And when I say close the entire property, I mean to also capitalize those closing costs and platform fees and reserves, we actually can close the property with just the equity and kind of around like 5% closing costs at the table. So these properties are always closing on schedule, even if the dollars aren't fully raised. That might be a question in your mind as well.
Perfect. Yeah. Aggie commented on playback. Are other people getting playback issues with chat? It looks like it's good on mine. All right. Anyway, we'll dive into it. Really appreciate all the questions. Obviously, continue to pepper those in. We're more than happy to answer them. Obviously, a goal of every one of our webinars is to stump Joey. He is the real estate king, and so any questions that you can do to stump him, whether it be tax loopholes, tax incentives, that usually gets some people. But anyway, I digress. I'm not trying to feed any fuel to trying to stump Joey. And if not, he'll probably sidestep it pretty well. Anyway, let's dive into it. Obviously, went through the Pinkman. Let's go into briefly the piggy bank. And then I think after like 5 minutes, I think we can unveil the new property, which we pre-veiled earlier. But
Incredible. Yeah, so here is the piggy bank, aptly named by one of our incredible investors here. So this one is in, let's go to the location. This one's around Mesa, Phoenix, close by to where the roads, or relatively close by to where the roads was, at least in the MSA. So, just focusing on kind of what the product is, right? This one is an 8-bed, 2-bath, turnkey pad split. I mean, you can look at the photos yourself on the platform, and also check out the pad split listing. I would encourage you. Really, really great property here. It's been stabilized and operating at least with only 1 bedroom vacant in the past year, which is great. There's an NOI yield of over 9% for a full year of investment operation on the current basis today, which is really, really great. That's just something you don't see in the open market. That's really that competitive edge that we were speaking about earlier, which our operators also create for us, being they have brokerage capabilities, right? And can go out and source these deals from active sellers, their current owners that are looking to market their properties but haven't done it yet. So it's usually 60 to 90 days, even pre-market, pre-MLS listing. Right now, the property is 100% occupied as we track to closing. So I would definitely urge you to take advantage of the fundamentals that just already been proven out. We do have year 1 rents below where that T12 trailing 12 performance has been, which is very, very conservative. And we typically like to do on operating properties. And then again, this one's capitalized with a 70% LTV loan with a 6.75% interest rate at the rate floor with our partners, which is really, really great. And again, as Alex said, that's 10-year interest only. That then converts to 30-year amortization post 10-year interest only. So that's a fixed rate of 6.75% over 10 years if we don't choose to refi in that time frame, which is really, 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 really tremendous. And especially when it comes to that accretive leverage proposition, right? Because all we have to do is generate an NOI yield over 6.75%. And again, this one already has a trailing 12 months of 9% over today's purchase price, mind you. And that's just something that you don't really see in the open market. So really, really excited about this. It has a backyard. The tenants are really, really great. And they've all been onboarded to pad split. And our manager, Corey, out there is doing a great job. So
and definitely don't miss out on this. If you refresh the page, I think we just got another investment into it. And I believe we're at roughly 50K. There we go, 50K remaining in the property. So obviously get a hold of that. And so for those of you just joining us, what is pad split? It's room for rent. We're workforce housing, individual room. You take a 4-bed, 3-bath, you convert it to an 8-bed 2 or 8-bed 3-bath. You rent out each individual room on a 12-week plus leasing. And as a result of it, even though the rooms are more affordable on a unit basis, on the whole, it presents a premium to even short-term rental income. So higher yielding asset class, even relative to your short-term rentals out there. And so we obviously like them because they've been high yielding. We have multiple above that 11, even 12% plus cash on cash yield year 1, which again, with margin expansion over time, as most of your costs are fixed in nature, technically speaking, as inflation continues to push your rents up, you'll have what's called margin expansion. And so that's why year 1, your yield might be 11%, but the average yield over a hold period might be 14% because you have margin expansion with, again, a majority of your fixed costs being your bottom, and then obviously your top being the rental income. And then obviously, Joseph, appreciate you hopping on again. When I've talked to the pad split in the past, they've indicated that a pool is not desirable for their product. Had their position on that changed, or is the rest of the deal just good enough to ignore the issue with the piggy bank? I mean, Joey, go for it.
I definitely agree with that. I think most of the product that you're looking at, especially in a market like Atlanta, you're just not going to have an opportunity to have many amenities, right? When it comes to yards and open spaces and pools. And the idea with pad split is density, right? You're trying to effectively get as much out of the existing square footage as possible with the most amount of bedrooms, while trying to maintain, private bathroom access to as many people as possible. So this is a relatively unique opportunity. All the current active tenants love the pool, and it definitely can translate into a slight premium when it comes to those weekly rates on the pad split platform. When it comes to thinking about scale and a portfolio wide approach, I would definitely agree with you for sure, Joseph, that we would not want to target, specifically midterm rentals that have more amenitized, like you said, pools and large spaces that don't account for that density that you're trying to get out from your typical pad split model.
Not to mention Mesa. I mean, that place is devilishly. I mean, we're dealing with a heat wave right now in DC, but Mesa is horrendous. No offense to anyone living there. I think it's a great market to buy in, but yeah, as my
It's hot.
sister moved out to Phoenix out there, I can only visit her a select few months of the year. Anyway, Joey, obviously, I think we've given them enough of a waiting period. Shall we dive into the big reveal? New property. Boom.
Boom.
Go.
Yeah. Honestly, this one really speaks for itself. I mean, just objectively, it's the most unique property that we've kind of found. Looking at some of the pictures here more in depth.
Wait, real quick before we
Yeah.
do that, Thomas, can you drop the link in the chat? That way people can follow along. But anyway, Joey, go for it.
Yeah. Just so this one is aptly named the Art House, by actually the current owner, who is also going to be a partner of ours. Super excited about that. Each room is themed and kind of has a gallery of art in it, which is really, really fun. These pictures actually don't specifically show the art that's strewn about the common areas, but they fully renovated this property top down. So if you look at like any Zillow listing or MLS listing today, you're really not going to find these active photos now. This was a completely off market deal. Product wise too, super unique. It's actually 9-bed, 9-bath. So every single bedroom, which 9 beds of density and around 2,000 square feet of living space is really, really solid for a pad split, something you don't typically see. And then having private 9 bathrooms in addition to that is just, you couldn't ask for a better layout in terms of the experience that the tenants are getting in this kind of layout. And the pricing makes a ton of sense. You're looking at a basis of $570,000 for the purchase price, and again, 70% LTV loan at 6.75% interest rate. This income is lower than what the trailing 12 months performance has been, and with that, you're getting to a year one yield of over 10%, right? So it's just tremendous value proposition. It's also a larger deal, relatively to some of, say, the smaller Atlanta deals that we look at, right? Which typically can be in the 300 to 400,000 purchase price range. That's just a factor of location, again, where they're kind of at in terms of this more like suburban landscape outside of your downtown CBDs and in central MSA locations. So yeah, really not much else I can say. Honestly, it's just really great value proposition. This one's located in the 3rd Ward, the University area of Houston. So actually really solid location that's closer to your kind of downtown CBD, which is more unique for pad splits, especially in the Texas areas. And then again, you can see the capitalization table down here. You can go in and check out the market fundamentals per usual. See your docs here, see kind of the major partners here. And then if you want to go into the analysis tab, I highly urge you to check that out and kind of play around with some of the assumptions, because we're being very conservative here with our year one rents compared to where the properties perform. So really unique opportunity. Haven't seen a 9-9 in a while in terms of 9 beds, 9 baths, and hoping to get more product exactly like this. Seller is going to be hopefully a partner of ours going forward for both supply and operations as well. So really, really excited about this.
Yeah, he fully ground up, purpose built pad split from Ryan. Is that? Yeah. Anyway, appreciate that. And then, yeah, I mean, holy crap, what a beautiful property. I would have thought that was an Airbnb, and not to mention too, you got Banksy on the wall. Come on, come on. I mean, it's no banana on the wall, but it'll do. It'll do. Not to mention too, obviously you have the analysis tab. We put that in the chat. If you refresh the page, I think we just got our first of probably many investments going into this property. We expect this one to sell out. There we go. Boom. Another investment. Again, this is going to be VIP pre-sale for you all. You have until Thursday to invest in the property before we launch it out to the public. So if you invest, just so you know, it won't show up on your portfolio page until we unhide the property on Thursday. So if you invest, it should go through. And again, if you think it hasn't, double confirm with us. We're pretty responsive in the chat. So definitely reach out to us there. But again, this property, Joey, I mean, we're not allowed to necessarily recommend any properties, and this is by no means a recommendation. But I got a text from Joey when he was minting this one late at night saying, God, this is one of my favorite property. This is my favorite property. So obviously every property he says that, and I get that text every time, but regardless. And then wait, if we refresh it again, I think we got another one. Boom, another 5K, 10K on the, oh, that's 12, 11K, 750. Nice. Okay. Yeah, it's a late night. Anyway, Nate, when evaluating these, are you avoiding flooding zones, etc.? I know some parts of Houston has its challenge over the years. How is this one sitting? Joey?
Yeah, so I mean, it's a good question. Like, I don't particularly hone in on kind of the flood zone and flood ratings of these. It's definitely important to know and something to take in consideration. I think that really comes into play with diligence, like when it comes to getting all of our insurance in place, right? Both on the liability side, on the dwelling side, on the landlord side. You will very quickly see those premiums shoot up, and it'll raise a red flag that then requires more hands-on diligence as you're going through the acquisition process of these. But this hasn't raised any red flags. We have seen areas of Texas, especially closer to the kind of beaches and where you've seen previous hurricane activity and tornado activity that do have higher insurance premiums. And then that's when it becomes more of a, again, hands-on issue decision-making process through diligence, where you're actually analyzing the risk and the risk reward of operating a property that's in a highly rated flood zone or at-risk area for anything really, fires, any other force majeure acts of God. So great question. Great question.
Yeah, and Ryan just followed up. It's in a preferred flood zone with low flood probability area near the central business district. So flood zone maps from government can't be relied, as we have seen in other parts of the country. Definitely something to consider, especially as you're investing in the different properties. And that's something that comes out, especially in the diligence of each individual property. And so with that, shall we dive into the analysis tab, or have we given enough time? Obviously, feel free to continue to pepper in questions by all means. To what degree are these properties insured?
To what degree are these properties insured? Yeah, so I mean, we can talk about quickly the two forms of insurance. I know we typically cover it in a lot of our other sessions, but the two forms of insurance that we take out are dwelling insurance and then liability/landlord insurance, right? And so your dwelling insurance is mirrored off of your typical homeowner's insurance, right? It covers any and all coverages for the dwelling that would be again associated with force majeure, acts of God, nature, weather, things that are out of control, and even internal leaks and stuff like that, that we can get covered as supplemental coverage, all within the dwelling of the property, right? And then separately, you have your landlord insurance, your liability coverages. So that'll cover anything from incidents on the property. Loss of use is one of the most important coverages that we have, and loss of use is really ensuring the property at its historical performance, gross potential rent, taking that into account if the property is uninhabitable, and then actually getting paid out according to its historical performance, which we've seen actively happen actually with one of our properties, the Roman in Texas, during Hurricane Beryl. So tried and true, really, really important stuff on the liability side. It covers any and all kind of worst case scenarios, skies falling scenarios when it comes to, again, someone getting injured, someone suing the LLC, which has nothing to do with the individual investor. The LLC itself holds all of those limits of liability, right? And any associated operational risks that are then insured against with that liability insurance. And then that loss of use comes in to cover any scenarios where you're not getting operation out of the property. Dwelling covers the property itself. So those are kind of the insurance contingencies. And then, as I mentioned before, we have a vacancy reserve and a maintenance reserve to cover your operational contingencies and maintenance contingencies on top of that.
No, great. Couldn't have said it any better myself. I will say that time in the Hurricane Beryl instance, that was a 1.22% monthly cash on cash yield, so roughly 14% annualized. We paid out through the hurricane, so that speaks directly to actually the flood zone issue that I mentioned earlier. Because I will say this is another Houston property that we got triggered that property or landlord insurance on there, and so. Joe, if you're looking for the analysis tab too, we have that pulled up in the chat. If you scroll up, outside of that, if we go through the, you're jumping into it, right?
Yeah, sorry, where do we see it?
If you just go to the chat, we pasted it in the chat.
Perfect.
Yeah, and then so while we're doing that, our pad split tenants also required to have renters insurance, Joey?
Yes, that is so sorry. Yes, through the pad split platform, they have their own insurances that are covered outside of our insurance. So we don't have to take out any additional insurance that the tenants are covered for on the pad split and Airbnb platforms, actually. Let me refresh this really quick.
Perfect. And I also just slacked it over to you too.
Perfect. Are you able to see my screen, or is it sharing something else?
It is sharing just a blank screen, the underwriting screen.
Okay, here, let me.
While you get that pulled up, I will answer. As an investor in a property, would you provide occupancy data regularly, say every quarter? So we give memos for each individual property on when tenants move out and when tenants move in and stuff like that. I will say that is something and a feature that we could potentially have in the future as we continue to disseminate information again. That's great feedback, and we hope to incorporate that shortly, especially given the fact that a lot of the changes that we've made to platform have actually come from comments in chats like this, or the actual, if we look into, for instance, if you actually look at the platform, a lot of the portfolio page analysis, all of that sort of stuff is definitely something to consider and stuff that we look to change. So yes, we can continue pipe in that occupancy data regularly. And outside of that, I mean, if you do have any other questions, feel free to shoot them over the chat, especially as Joey is pulling up the calculator for us on that one. But outside of that too, Joe, if we need to make changes to the underwriting too, by all means, we can do that and shoot over the revised calculator after the fact. If that works best with everyone.
Yeah, maybe I'll do it that way. I just want to triple check. It looks like, when everyone's kind of playing around with the different version control, sometimes it gets changed, but let me make sure that we have the right one. I'll send it out after this.
Definitely. And so in the property page itself, though, it is kind of separate. So don't worry about it. It still shows it in the investment calculator on the property page. So that one is accurate and up to date. So we'll plug into the calculator and send it over after the call. That way everyone can review it. I mean, outside of that, Joey, if we want to dive into anything as it relates to the property performance, if people do have any of the questions, we can dive into that portfolio wide ones. Obviously, we like to give back as people show up to these webinars. We've now, in the past few webinars, launched 3 separate properties, I believe, or last 3. On top of that, too, we put in a swag order, which honestly, I wasn't going to wear it today. I'll wear it at a different time. We got the charcoal hat, which I love.
Toss it on.
Toss it on, dude. way too long. It's like, also, this is not sweat, even though it's 95 to 100 degrees in DC right now. It is not sweat. I had to shower because I was sweat. Anyway, this is that hat. We got that going, which is nice. Good stuff. Good stuff. So you'll be getting that too if you put in that order. The second one, which I was actually kind of shocked, obviously in our chat last time when we asked preference on dark versus white T-shirt, I would have expected it would not have carried over to hat, but a large majority of people are going for the charcoal hat. But this one, I mean, this one I love, dude. This is kind of like the Scotty Scheffler Nike hat. It's embroidered too. It's got a Nike. It's a very nice fit to it. Anyway, this is not a try-on session. This is more so just a show with everyone that we more than appreciate your time, especially on these last Tuesday of every month, as we continue to put this forward. And if you put in the order for the swag, we are going to be sending that out here shortly. We actually had more people than expected respond to the survey, so we're getting a lot more orders of it. White Hat, let's fire. Thank you, Dan. Appreciate it. That was a large push by me. I said I refuse to admit that the white versus dark T-shirt carries over the hat. I think the hat looks incredible. I've been wearing it anytime I'm out. And so, anyway, Joey, what do we want to talk about next? Obviously, we've gone
Yeah,
through the
I like Ramesh's question here. Investor in a property, would you provide occupancy data regularly, say every quarter? So the good part about your portfolio page is you can see the active performance of each property. So if I go really quick into my portfolio page here, and then I show you what I am looking at in terms of historical performance. Let me see. Let me know if you can see that.
Yeah.
Perfect. So this is the historical performance of each property, right? So if I actually like click into one, I can see the breakdown of how it's been performing. And really in our models, right, when you're looking at like just your typical underwriting model, you can really equate your GPR to what the occupancy is. So I would just take a look at like what stabilized gross potential rent is, and then you can kind of gauge, you know, if this is an 8-bed property, and there's 1 bed vacant because of a turnover in the month of June, say, you'll be able to glean that relatively quickly, right? And so while we don't publish specific occupancy numbers because they actually change month to month, you can definitely track it based off your gross potential rent. However, it's not a bad suggestion to maybe look into how we can potentially incorporate that in the future. And that's the great part about operating with this customer feedback, is we're always incorporating changes. We're always looking at things to do to improve the platform, and things that we can do to make your experience even more transparent and better as real estate investors.
Definitely. No, I mean, it was discussed a little earlier too on the portfolio page update, was done via a comment in the chat just like this. So appreciate that. Ramesh, also another question. Can you share how many investors you have across all properties and average investment per investor? Typically speaking, average investment per investor has been actually trending upwards, especially as people continue to gain more and more confidence around the platform and the properties continue to perform. So originally, when we set out to go about these investments, we thought, okay, we're probably going to get a majority of people coming in at $250 investments and basically being kind of like the real estate for all platform. I will say, as the returns have continued to increase over time, people have been coming back and it'll be multiples of their first investment. And so as a result, it's actually hovering closer to that 5 to 10K range is the average investment. Now, number of investors we have on platform today, it's around 10,000 investors across the platform. So we're continuing to grow like crazy. We've done this on a pretty limited shoestring budget in terms of the actual marketing spend. And so it's been more of these grassroots types approach. So definitely continue to spread the word. We really appreciate it, especially as you continue to send out. And the next thing I believe is a clubs related question. Could you please explain a little bit more about how club rewards operate? Do users receive rewards from all clubs we are part of, ongoing all clubs, or do we only receive rewards from the last club we contributed? Do we have to have contributed in each club to receive future rewards? So the last part of your question is correct. So if you invest here, I can actually walk through a club investment real quick. That way we can dive into it. Here we go. Can you see my screen?
Yep.
Perfect. So clubs, obviously you come here, you can check out the club. You can see the individual, obviously overview of the club. People continue to post in here. Now, as you invest and you attribute it to a club, the rewards get kicked back pro rata to the amount you've invested with your attribution to the club. Meaning 2% in this club is being kicked back to end club members. And again, you benefit with the more people that are investing through this club. So go ahead and remember to invite a friend, copy it, send it across to your friend. And anytime they invest into the future, everyone benefits when the club gets grown out alongside one another. And so you can see, obviously, club rewards are continuing to trend up as the members are continuing to trend up. And as you can see, it's commensurate with one another because obviously 2% is the rewards amount of every dollar. And again, it does not impact the end investor. It actually comes out of our revenue as kind of a thank you for you helping to grow out our platform. Now, on the properties page, this is important because it relates directly to your question on the club rewards. Let's say I'm a member of several clubs, which right now I believe I'm a member of a majority of clubs, if that, yeah. Anyway, then I come into the properties and let's say I'm going to invest in the Pinkman or invest more in the Pinkman. And let's say I'm putting in 1250. Now, if you can see here, the club, I can basically come in here and decide with the club, all right, which club am I going to allocate it towards? And if I'm a member of the 400, I'll click confirm club. And when I confirm and allocate, it'll be allocated towards the 400 club. Now, it has to be, you have to invest and have it attributed to a club. If you're a member of one club, it'll only go to that club, and every investment you do will be attributed to that club. If you're a member of multiple clubs and you want to kind of spread the wealth and generate income from a variety of different clubs, then you can kind of pick and choose which one. It really is, if you're familiar with liquidity pools or staking, it's basically staking in each individual club, meaning staking is in crypto, whereby you basically pledge your assets as collateral in a pool. And as a result, you get pro rata rewards. And if you stake in multiple pools, you get pro rata rewards from the multiple pools. That's kind of where the concept originated from. And the idea here is as you invest in properties, everyone benefits, even on top of the market beating returns. But will we receive rewards from all clubs we are a part of? Yes, but only if you invest and allocate to that club, right? And so the idea being that if I invest $10,000 in the Pinkman and I allocate it towards the 400, that 10,000 is divided by the total amount in the club. So right now it's about 550. So 550K. So it'd be 10K divided by the 550K is my pro rata of all rewards kicked back to me. Now let's say I still have that 10K invested in a property which I had allocated towards the 400, and I invest 10K in, let's say, the Avalanche Club, and there's 200K, then I have 10K of 200K in that club and 10K of 550K in the 400 club. So meaning that way you can basically gamify the system and decide which clubs you're investing in to generate the most rewards. And it's almost like a yield farm whereby, am I investing in this club, which has less members, but I get a higher pro rata of the amount invested? So anytime anyone comes in, I get a higher pro rata of the rewards. Or am I investing in one that has a lot of members that's constantly investing more and more, and I'll get a lower pro rata, but maybe a greater nominal amount? And so that's kind of the trade-offs. I know I went in. Joey, did that make sense? And did everyone make sense?
Yeah, it
I
made
know.
sense.
Yeah. Yeah, but you just say that. But anyway, and Ramesh, appreciate very clear answers to the various questions being asked. Yeah, appreciate the obviously hard-hitting questions. And Brad, let me know if you need any more clarity around that. Obviously, it's a newer concept, but basically, high level, the more you share, the more you invite your friends to the clubs, the more everyone benefits from sharing in the rewards of the real estate. And who doesn't love a 12% cash on cash yield? Regarding year-end tax documents, what would we receive? 1099 per property/investment or K1 for each investment? it'll be a K1 per property. And so we pass along the passive losses of real estate. And so I'll slow it down, but real estate is a taxed haven, so to speak, meaning as you invest, you have a paper loss that you can put up against your actual gains of the property. It's called depreciation. And depreciation acts as a tax shield for all your rental income generated. So let's say I get a 10 to 12% cash on cash yield, but my depreciation tax shield actually shields the rental income. I don't pay taxes on the 10 to 12% cash on cash yield. And so we pass along that passive loss to you as an end investor. There are some pretty cool things around cost seg that you can potentially do to even boost it. And we're actually getting some pretty sophisticated CPAs on board now. That this year we actually did a complete switch over from CPAs as we had promised to everyone. And this year it'll be a pretty robust team that we're working with. Joey's helming that effort, and I'm looking forward to seeing what we can do around that. Outside of that, definitely reach out with any questions. Is the plan to do a 1031 exchange at the end of the 5 years? Joey, or I can touch on it, either one.
Yeah, go for it.
All right. Sorry, I had to drink some water. A lot of intense questions towards the end of the night. It's been a long one, I'll say that. But is the plan to do a 1031 exchange at the end of the year? For those of you not familiar, a 1031 exchange is a way to avoid a cap gains tax at the end of a life period of an asset. Meaning, if you sell an asset, and let's say you bought the asset for 500K, and that has since appreciated to $1 million, and that 500K is your net gain, technically speaking, the government would be owed 20% of that 500K. So your 500K net gain. Now, 1031 exchanges came in and basically said, if you sell your property and you buy a like kind property, meaning a real estate asset that generates income, then you can technically take the full proceeds and invest in new property. So you could take the full 1 million and invest it in a new property, and you would not owe taxes on that 500K. So you basically have a 100K savings in taxes by investing in new property. And on top of that, you get a much bigger property. And so that's the 1031 exchange in a nutshell. Now, do we plan to do that? There are some pretty interesting scenarios. So we actually have a secondary exchange coming online mid to late next year. The idea being that we could potentially set up a drop and swap. I don't want to promise anything there, but it would be a very cool 1031 exchange where you could do shares of one property and shares of another. As for the 1031 exchange at the end of the 5 to 7 years, the goal is to have a fully liquid secondary. So even at the end of the 5 to 7 years, you could potentially just sell out regardless. But we could put it to a vote for end investors. And as long as we have a majority of people willing to 1031, then we can do a drop and swap LLC 1031 exchange, meaning we have to have a majority of the people that are selling willing to go into the next property in order to 1031, especially within this structure. That being said, there are additional ways to get some capital refresh that don't require even a sale, whether it be a cash out refi or whether it be leveraging up against your equity on the platform. And that's something that might come in later down the road. But that's the benefit of having two guys that love geeking out about real estate and about finances, is structuring these types of financial instruments. That'll be very great. As for Angel, thank you for passing that appreciation tax shield. Thank you for investing in real estate with us. And Nate, got it. Thanks. Appreciate it. I know obviously it was long-winded, but I had to go into it because taxes, I definitely geek out at them, much to Joey's chagrin. Outside of that, we got a minute left. If there are any last questions, Joey, you got any questions?
Nothing from me. Nothing from me. Yeah, super productive. Really appreciate all the thoughtful questions. Always learn a lot from these sessions for sure.
Nice. Awesome. Well, that honestly, that does it for me. If anyone has any last minute questions, feel free to lob them. Thank you guys. This is a very important session. Thank you for showing up. Obviously, as we continue to do this, we will continue to bring more and better updates along the way. Obviously, you have this new property. We'll be sending it out after the fact with a link to the updated analysis tab, as well as the property itself. On top of that, too, the swag orders, they're coming in pretty I think we're sending them out next week. But appreciate everyone for joining it. Continue to spread the word of Mogul. And with that, I think that's a wrap, Joey.
Awesome.
Until next time. All right. Appreciate it, everyone. Thank you so much.
Thanks, everyone.